Okay, you've definitely seen the lines, you've heard the hype. Dutch Bros. It's not just a coffee company anymore, it's become a whole cultural phenomenon. But today, we're going to look right past that super vibrant brand and dig deep into the numbers. We're breaking down a recent in depth analysis to answer one single crucial question. Is this explosive growth story actually a smart investment? Let's find out. And yeah, on the surface, you just can't deny the success story here. Dutch Bros has built an incredibly powerful brand with a really loyal following, especially with younger crowds. They're expanding like crazy, opening new stores at a blistering pace. And believe me, the market has taken notice. But this is where things get really interesting. See, a great company doesn't always equal a great investment. The price you pay for that company's stock, well, that matters a lot. So is Dutch Bros a stock you should be running out to buy right now? This analysis gives us a pretty clear answer on that. Before we can even begin to talk about the price, we need to understand what we're actually buying. So let's start with the engine behind all this growth, the Dutch Bros business model itself. The Dutch Bros model is really built for two things: speed and scalability. You've got these small, efficient drive-thrus, a huge focus on a unique customer experience. It's just a recipe for rapid growth. Now, an analyst looking at this sees some clear strengths, right? That powerful brand and that super loyal customer base. The growth opportunity is obvious, but here's a key weakness that the analysis points out. The company's moat, its competitive advantage, is actually considered pretty weak. It's all built on that amazing brand culture, but that's not a structural thing like a patent, and that makes it really hard to defend against competitors. And it's a huge challenge to keep that unique culture perfect when you're growing this fast. All right, so we get the business. Now for the really fun part. Let's pop the hood and take a look at the financial engine that's powering this whole growth machine. And wow, this is where you really see the two sides of the Dutch Bros financial story. On one hand, you've got this explosive growth in revenue and earnings. I mean, those are the kinds of numbers that get investors really excited. But on the other hand, you have some serious red flags for a value investor. Almost no free cash flow and a massive, massive amount of debt. That 121% debt to equity ratio, that tells us they're borrowing heavily to fund this expansion. It's a classic growth at all costs strategy. This quote right here gets straight to the heart of the issue. Dutch Bros is making money, sure, but it's spending every single penny of it, and then some, on building new stores. Now, for a company in an aggressive growth phase, that's pretty common, but it also means there's no cash left over for anything else, like paying down that billion-dollar debt pile or returning money to shareholders. It is a high-wire act, for sure. So what does this all add up to? Well, for the analyst, these aren't just numbers on a page. They are clear red flags. The high debt, that increases the financial risk. Zero free cash flow, that makes you question the long-term sustainability. And that high short interest, that just means a significant number of other big investors are betting that the stock price is going to fall. These are some pretty serious concerns clouding that sunny growth story. So with all of that in mind, the strong growth on one side and the serious risks on the other, what does this analyst believe the business is actually worth? This brings us to the core concept of intrinsic value. And boom, this is where the analysis really hits you. The market is pricing Dutch Bros at over $52 a share, but when the analyst uses two standard valuation methods, one is a DCF, which is a fancy way of projecting all the future cash the company might generate, and the other looks at what a buyer might pay for the whole business, they get a much, much lower number, an intrinsic value somewhere between $22 and $28. I mean, that is a huge disconnect. This massive gap leads us to the margin of safety, which is a cornerstone of value investing. You want to buy a business for way less than it's worth to protect yourself in case things go wrong. It's like a safety buffer. Well, in this case, with the price being double the calculated value, the margin of safety isn't just zero, it's negative. There is no buffer at all. So why the huge disconnect? The analyst's theory is simple. The market is completely mesmerized by the growth story. It's pricing the stock for a perfect future where absolutely nothing goes wrong. It's just ignoring all the risks we just talked about: the debt, the intense competition, and the challenge of scaling that unique culture. But what if the future isn't as perfect as the market seems to think it's going to be? Well, the analyst also looked at a range of potential outcomes, from the best case all the way to the worst case scenario. Let's see how that changes what the company's worth. So the analyst mapped out three possible futures. In a bad scenario, a bear case, the stock is worth $18. In the most likely, or base case, it's worth $25. But here's the real kicker. Even in the optimistic bull case, where growth stays strong and margins get better, the analyst calculates the value at only $35. And remember, the stock is currently trading for over 50. This slide really sums up the whole risk versus reward situation perfectly. You've got a high risk score, a 7.6 out of 10, and that's driven by that super high valuation and all the debt. The opportunity score is a decent 6.8. I mean, the growth is real, but it's just not enough to overcome that high price and high risk. For this investor, it's just not an attractive setup. Okay, so we've seen the business, the financials, the valuation, and all the possible scenarios. Let's bring it all together for the final verdict. What's the bottom line? First, and this is so important, we have to remember the goal that frames this whole decision. The analyst isn't just trying to guess if the stock will go up tomorrow. No, they have a very specific target, a 9% average return every year over the long term. And this right here is where the rubber meets the road. To get that 9% return, the price you pay is everything. To hit that goal over 5 years, the analyst would need to buy in at $35. To hit it over 10 years, the price has to drop to $29. And for their 16-year plan, the required buy price is just $25. And there it is. For this particular investor, with their specific long-term goals, $25. That's the magic number. That is the price at which Dutch Bros stock stops being an overpriced gamble and turns into a sound investment opportunity. You know, this quote just perfectly summarizes the entire analysis. The analyst loves the business story, but finds the stock's story questionable. It's a great company, but it's just got a too high price. The potential for reward simply doesn't justify the risk when it's over $50 a share. So let's wrap it all up. Dutch Bros is a fantastic brand. It has a real growth story. But according to this deep dive analysis, the stock is priced for absolute perfection. And it's ignoring some major financial risks like all that debt and the lack of free cash flow. So the final verdict is pretty clear. Avoid or sell the stock at these prices and only think about it as a buy if, and it's a big if, it falls below that $25 per share target. And that's our breakdown of the value investor's case on Dutch Bros. It's a really fascinating look at the difference between a great business and a great stock. So, what company do you want to see us break down next? Let us know in the comments below.